Here is the number that matters this morning, Monday, August 17, 2026. Futures traders are still assigning a 30.6% probability to a Federal Reserve rate rise at the September meeting, a quarter-point move that would take the benchmark target range to 3.75 to 4%. Goldman Sachs is telling clients that this is far too hawkish, and its chief economist Jan Hatzius now says a September hike is extremely unlikely. That is a direct collision between market pricing and one of the most influential voices on Wall Street. It matters because those odds feed into the dollar, bond yields, mortgage pricing, and the liquidity conditions that drive crypto and other risk assets. Goldman's argument is not a vague feeling, it is built on a clear data chain. Retail sales have come in softer than expected, and employment numbers have disappointed. When consumers spend less and the labor market cools, there is less upward pressure on prices and less need for the Fed to raise borrowing costs. At the same time, inflation has continued to cool, which removes the central bank's main justification for another hike. Despite that, Goldman says markets are still carrying too much hawkishness across the forward curve, the market's expectations for interest rates at different future dates. In plain terms, traders are overestimating how much tightening is likely not just in September but further out as well. The immediate market effect is already visible. Softer rate expectations tend to weaken the dollar, because lower expected yields make dollar assets slightly less attractive. That is why the story landed this morning as good news for Bitcoin. CoinDesk noted that a September hike being deemed very unlikely eases liquidity pressures on cryptocurrencies through a weaker dollar. For ordinary borrowers, the effect is more indirect. If the Fed holds rather than hikes, short-term funding costs are less likely to climb again, which can support mortgage pricing, corporate credit, and overall risk sentiment. But this is not a signal that the Fed is about to ride to the rescue with rate cuts. Looking ahead, the base case now centers on a hold at the September meeting. Goldman is not calling for a Federal Reserve rate cut this year, and the data would need to weaken much more before that conversation seriously opens. The more important signal is that the market's forward pricing may have to unwind. If that happens, the pressure on the dollar should ease further, and the backdrop for risk assets could stay calmer if bond yields adjust lower. The key watch points are the next round of U.S. labor market data, retail sales, and inflation prints. If those numbers continue to soften, the 30.6% hike probability should fall even further, and the debate will shift from whether the Fed pauses to how long the pause lasts. So the takeaway is this. The story today is not that the Federal Reserve has suddenly turned dovish. It is that markets are still paying for a hawkish scenario that the data no longer supports. That gap between the 30.6% futures probability and Goldman's very unlikely view is the real tension point for traders. If Goldman is right, the path of least resistance for the dollar is lower, and the breathing room for Bitcoin and other risk assets has improved. Watch the data, not just the rhetoric. The Fed's next move is now more likely to be no move at all, and the market's job over the coming weeks is to catch up with that reality.